partners of PCI. We're based in Melbourne. We've got an office in Sydney as well. We do work nationally though, so we made contact with Rudy and Samantha the other day when we're really thrilled to have the opportunity to talk to you about, which put on a series of webinars, seminars for you, which we think is very topical at the moment. And this first one is very much designed as an introduction to give you an idea of the sorts of things we're seeing, what are the signs, etc. So at that point, I'll hand it over to Steve. But we would really like, at the end, we'd like to get a bit of feedback in terms of what you're hearing from your customers as well. If any, sparks any sort of questions. But please put up your hand, or else just interrupt at any time. We're happy to take questions all the way through. So that's pretty much it. Over to you, Steve.
Yeah, thanks, Chris. I suppose we talk to a lot of accountants around the country, and we've had a lot of discussions, in particular since sort of late March, about issues that are confronting different clients, and some of them are single one-off type issues that we've discussed with them, and we've been able to try and point that client in the right direction as to how to actually deal with those sorts of issues. And there are others that where one issue tends to lead to other things coming out that need to be dealt with. So okay, so I might share my screen at this point. Okay. Now, can everyone see? Excellent, good stuff. Okay, let's see if I can get all this working. Okay, sorry for that. See that?
Operating now.
Excellent. All right, good. Sorry about that. I'm not sure. We've done so many of these seminars, and just in the last month, all of a sudden Teams has been playing up on us, and so we've actually switched across to Zoom for quite a few of the things that we do. But anyway, we're there now. Okay, so one of the things that I want to talk about today is, in particular, what we're seeing from an insolvency perspective, and talk about the sorts of issues that you might get confronted with a client. And the aim here is to try and just give you a little bit of information about when you see these factors, it might lead to a question about whether or not that particular client might need some intervention of some sort or some insolvency help. So the industries that we're seeing in particular that, and there's probably no big surprises here because they're the ones that have been affected mostly by lockdowns and restrictions. Hospitality, so we're seeing a lot of businesses, restaurants, cafes, but in particular also pubs and clubs. And when I say clubs, I'm talking really about those that might have gaming machines in particular, because they haven't been able to operate, particularly in Victoria, since March this year. And so it's only, there's only so long that a business can sort of sit there in hibernation before, problems start to emerge, and also where do they get the working capital to start up again. Gymnasiums, I mean, if you look at the one thing that's happened in South Australia over the last couple of days is gyms have now shut again. So again, those sectors are really, really hurting. Tourism, surprisingly, we haven't seen personally as much contact from travel agents as what I thought. And it might be that once business starts to get back to some sort of normality, I expect that we'll see a lot of travel agents. A lot of travel agents still can't operate because, they do international travel. They've got to switch across to domestic travel if that's what they're doing. And I think that sector is going to be really hurting. In the regions though, if you're able to get your business back up and running again, if you're a tourism operator, and you might be providing accommodation, or you might be providing, you might be a restaurant or something like that that's up in the regional centres. I think there's going to be a fairly large amount of demand for those sorts of services going through Christmas. The real concern, I suppose, is, Christmas is fine, people go away, the holiday domestically, but what does that mean when it comes to, say, February? Does that sector then start to suffer and go through a fairly quiet period of time? So if you've got clients that are operating in those sorts of sectors, it's probably worthwhile having a discussion with them to make sure that they've got plans for when demand actually starts to ease off come next year. Retail, well, look, we've spoken to quite a few retailers. Some of them have been able to pivot across to online sales. Anecdotally, what we see with online sales is, whilst some of these sales have been, turnover has been actually quite good, and has been, you've seen some massive percentage increases in online sales. What you don't necessarily see as well is that there's a lot of returns that come back in. So for every return that comes back in, that reduces the margins. So there is certainly, some industries within retail that have sort of, whilst they've had good online sales, those sales have been affected, or the margins have been affected by the fact that a lot of returns have come back in. Construction, look, it'll be interesting to see how construction's gone. I think that, their commercial construction, it's a little bit down at the moment. Some projects have been put on hold. But again, the government is throwing a lot of money at that particular sector because that is one of the engine rooms of the economy. So there were some changes to some of the insolvency laws, and those changes came into effect in March, and they were due to end in September, and now they've been extended to the end of December. There is no talk, certainly at this stage, that they'll be extended again to, say, March next year to coincide with JobKeeper. But effectively what happened was the government's done its very best to try and limit the amount of insolvency work during this period of time. And one of the ways that it's done that is that for a company or for an individual, they can have a demand issued on them to pay particular debts. So with a company, it's a statutory demand, and it used to be that a stat demand was issued, it was sent to the registered office, and some of you might be registered offices for your clients. And what would happen would be that they had 21 days to pay, and if they didn't pay within 21 days, an application could be made to wind up the company. Now, the minimum amount that could be claimed in respect of the statutory demand was $2,000. Now, Chris, if you could just mute your microphones as well, that'd be great, because I'm getting a little bit of feedback. That was extended to 6 months, and the amount was increased to $20,000. And it's the same with bankruptcy notices as well. So if someone's trying to make somebody bankrupt, they can go to court, apply to make them bankrupt. Again, there's a notice that's actually issued called a bankruptcy notice, and again, 21 days was the time limit on those bankruptcy notices, and the minimum amount used to be $5,000, but again, that's increased to $20,000. So what we might see at the end of December and going into next year is maybe the amounts and the time limits increasing, but I think what we'll start seeing is some of these notices starting to be issued. And I think they'll be issued fairly often because they are one of the main means by which debts can be collected. One of the other things that happened was that there was a moratorium on insolvent trading. So if a director incurs debts in the ordinary course of business between March and the end of the year, 31st December, they can't be, if their company subsequently goes into liquidation, they can't be held liable for insolvent trading. So the way insolvent trading works is that company goes into liquidation, a liquidator will have a look to see at what particular time that company became insolvent. And it might be because the tax office hasn't been paid, creditors haven't been paid, and the liquidator will choose a particular date, and then all the debts that were incurred after that date, the director might be held personally liable for those debts because the company was insolvent at the time, and therefore there's insolvent trading liability that might fall upon the director. So with this moratorium that's in place, as I said, as long as the debt's been incurred in the ordinary course of business and the company subsequently goes into liquidation, then the director won't be held liable for those particular debts. One of the questions that's come about is that if a company goes into liquidation after the 31st of December, does this moratorium still apply? Now, there's no case law on any of this, but it's been certainly flagged in the insolvency circles that a company probably should go into liquidation prior to the 31st of December to enable it to the director to have this protection. But again, there's no case law on it. It's just been flagged as a potential issue that might arise should a company go into liquidation after the 31st of December this year. So what are the signs that a client might be in financial trouble? And so these are sort of, they're in no particular order as such, but these are the sorts of issues that we constantly come across. And as I said before at the introduction of this, it sort of, it flags that it might be an issue with a client, and you might see some of these with the clients that you've got or clients that might come to you. So one of the very first things that we see is that tax has been falling behind. So one of the very first signs that a company has got financial trouble is that there's a debt due to the tax man. And in many respects, the tax man is generally the first not to be paid, maybe the second after accountants not to be paid. But certainly just about every job that we come across, the ATO is a creditor, and in a lot of the jobs that we get, they're actually owed taxes going back, maybe many years. And so one of the issues that comes up is when we see tax outstanding for a period of time, it generally indicates that that company's in financial problems. One of the other things that we see is that tax lodgements aren't up to date as well. So, and the reason tax lodgements aren't up to date is because there's a general view that if you lodge your BAS statement, you're going to then tell the tax office that you're owed, that they're owed X amount of dollars, and the tax office will start to come and collect it. Superannuation, so they fall hand in hand. In many respects, what we see is super not being paid, GST not being paid, PAYG not being paid. So they're the sort of the main ones that we see. Super, though, can in fact trigger, in many respects, a superannuation audit. And it might be that there's some employees that work out, they contact their super fund, they find out that the superannuation hasn't been paid for quite some time. They then ring the tax office up and report it, and that sometimes triggers a superannuation audit. Generally speaking, once a super audit is triggered, the company's well and truly on the radar for collection activity by the ATO. So during this period of time, ATO has been pretty generous in the way that it's been dealing with outstanding tax debt. If you wanted to get a deferral, probably up until the end of September, it was relatively straightforward to get that. Now it's not so much a deferral, it's actually the ATO looking for payment arrangements to be put in place. The longest payment arrangement that I've heard in this environment so far is 5 years, but generally you're talking about payment arrangements for, say, 3 years, supported by cash flows and accounts, and also that's where the accountant as the trusted advisor is really important, because the accountant puts a lot of that information together to put to the ATO. Please ask any questions as I go through. I'm happy to answer them, or any comments that you might have as well. One of the other things that we see a lot of is where there's been a loss of a key contract, and generally speaking, what we find there is that there are a lot of businesses out there that have maybe only a handful of customers, and out of that handful of customers, you know, one or two of the customers are actually key. Key to the extent that if that particular customer falls over or they lose the contract, then it puts the viability of that particular client at risk. And we see it quite a lot. And if you think back, you know, one of the biggest administrations that was done this year was Virgin. If you were, say a caterer or a cleaner to Virgin, and that was your main contract, with Virgin going through the financial trouble that it's had, or not being able to operate to the extent that it is, you know, you might find that those sort of businesses might in fact be vulnerable. Now, I'm just using, well, I'm not sure whether that's happened or not, but certainly those clients that only have one or two key contracts, you should look at those to, you know, give it a bit of a stress test to see whether or not, you know, if something happens to their key client or customer, that they're going to be able to survive. We're seeing a bit in the landlord space as well, and there are different rules in different states for how landlords deal with clients, but generally speaking, the way that it operates probably up until the end of this year was that depending on what turnover drop that you had, 50% of that turnover drop would be applied to a deferral, and 50% would be a waiver. What happens from the end of this year, though, is that rent goes back to the full amount. And once it goes back to the full amount, you know, is your client going to be able to pay that? So again, in having plans put in place for those sorts of clients that might be affected by that, you know, you're going to have to look and see whether or not, you know, there's just going to be this debt burden that continues to accrue, and what the landlord's view on it is. Now, I've spoken to a number of clients of accountants that have got problems with their landlords, and generally these problems have arisen well prior to COVID. I had a very large restaurant chain that I spoke to, and they had one of their sort of key stores or key venues had issues with their landlord over quite a period of time, and in fact had taken the landlord to court because the landlord had refused to fix the toilets, and ultimately that particular tenant had won that case. The landlord had fixed the toilets, but the relationship with the landlord wasn't particularly good at all. And of course, during this period of time, there's a lot of concern by that particular client that the landlord you know, evictions somewhere maybe post-March next year, that there'll be a fair amount owing to the landlord which they won't be able to pay, and they may very well be evicted from their premises. So again, it's really important if you've got clients, they're running, they're leasing venues, or they're leasing space from a landlord, to make sure that they're actually, firstly, the landlord's on board in terms of opening the business up, and certainly there's a lot of that landlords that are, but also, you know, what happens when the rent goes back to the full amount? Are they going to be able to afford to actually pay it? Even if demand's good at the moment, as I was saying, is demand going to be good, say post maybe February, when you know, holidays are all over and people have gone back to some sort of normal work environment? We see this again quite often. Legal action, generally it's one creditor who is agitating for payment of a particular debt, and they're taking all sorts of action to try and get that debt recovered. So it might be legal letters through a debt collector, it might be action to try and get a judgment. If they get a judgment, maybe sending the sheriff in to try and repossess some goods, even to the extent of winding up applications against a particular company. For individuals, again, you know, creditors trying to get a judgment against them. so that they ultimately might be able to move to a bankruptcy notice next year. So we're seeing a bit of that. If your clients have got those sorts of issues, again, they need to be dealt with pretty quickly. The one theme that will flow through this presentation is the quicker that these issues are addressed, the more options that are available to a business to try and deal with them. There is quite a few occasions when we get a phone call and it might be from an accountant or a solicitor saying our client has got a winding up application against them. It's being heard in court tomorrow. And when you get those sorts of calls, there's really only a very small amount of options available to them. Whereas if they dealt with it maybe 2 or 3 months beforehand, there might be quite a few other options that they might be able to go down, a few other routes that might actually solve the problem. One of the other issues, we had a seminar last week that we ran with Judo Bank, and we spoke about financiers and supporting business. And again, the key takeaway from that particular presentation was you need to deal with the financiers earlier or sooner and have an open, frank discussion with them about any issues that might be, any assistance that might be required. And when you do that, you generally find that discussions go a lot better, they're a lot more transparent, and everyone knows where they sit. And hopefully the financier is actually supportive of the business itself. It's really important though that the business has got a plan as to how it's going to see itself through any difficulties that it's currently facing. Sometimes we see things like partnership breakdowns. We've seen a couple of those during this period of time where the partners have worked out, or the shareholders have worked out they don't really like each other anymore, and sort of the COVID sort of restrictions have they've had to rethink about what they want to do, and of course they want to get out of business. And we're dealing with one at the moment where we've got a business that deals in excavation equipment. One partner wants out, the other partner doesn't, but there's personal guarantees and all sorts of things that are actually in place, and it's making it quite difficult to actually deal with when you've got a diverse view of what should actually happen to the business between the two partners, actually having that business go forward. And all that's really happening at the moment is that business is suffering, and ultimately if they don't do something about it, it has a high chance that it might fail. Again, during this period of time, we've had a lot of accountants ring us up and with their clients, and they've just been uncertain about what to do. And we had one very early on, which sticks in my mind, where we had a big retailer, and they were just sort of beside themselves. They had shut down. They didn't know what to do. They didn't think that that they could go on. And we spoke about it, and their problems weren't really as bad as what they thought. A lot of it, as I said, it was, they were worried about their landlord, but they hadn't actually had any discussions with the landlord. They were worried about their main supplier, but they hadn't, again, had discussions with the main supplier. And, we suggested to them, look, they don't do anything rash. Just start having some of those discussions, work out how you're going to reopen up the business, which is what they did. And anyway, they took that on board, and after the discussion, the accountant came back and said, look, it was good, they just need to get it off their chest. And then we followed them up over the next few months. They were actually able to open up again, and the business was actually booming. So they'd had those discussions with their suppliers, they had the discussion with the landlord. They were all very supportive and sympathetic towards the business, and the business actually doing really, really well. So sometimes clients just need to be heard as to what is on their mind, get some stuff off their chest, and then just give them a few solutions or a helping hand as to how they have to deal with their problems. Sometimes we get people that say it might be a sole director and shareholder that's passed away, and whilst the business is not a bad business, you can't actually operate without a director and the shareholder also needs to be dealt with. And if it's one of the same person that's passed away, that's a real problem. About the only thing that can happen is if a new director might be able to be appointed, but generally speaking, it'd be an application to the court to have the company placed into liquidation. If there's nobody else that it's possible to take over and run that particular business, because it's like a rudderless ship. The employees can't make those decisions and keep the company running. It needs the shareholder and the director in particular. So what's the best way to preserve a business, and what do we recommend you should look at for your clients when they come to you, and maybe just generally all clients when you're having a look and doing a bit of a stress test over them? What's the best thing to actually tell them? So these are sort of some ideas that we've got as to what you should be looking at when you're having these sorts of discussions with clients. So we know that JobKeeper's coming to an end. So JobKeeper's been really, really good. It's kept so many businesses afloat. So at the end of March and the start of April, when JobKeeper hadn't been announced, we were inundated with phone calls from accountants and solicitors and their clients, because they were so worried about how they were going to survive. JobKeeper was put in place. It's been really good for putting a baseline under the vast majority of those businesses. So when, as you know, JobKeeper is being reduced and it comes to an end in March next year. So it's really important that that when it does come to an end, those businesses that have been relying on it have got a plan to move forward. Okay. The next thing, as I said before, landlords. So a lot of landlords are suffering out there. Okay, and they're whilst I think a lot of landlords have been very sympathetic towards their tenants, there are some landlords that haven't been. But at the same time, landlords, if you think about it, they also have debt that they've got to service. And whilst they might be talking to their banks about mortgages and properties and deferrals of that sort of nature, at the end of the day, they actually need to be paid as well. And I think there's going to be a bit of pent-up demand from landlords trying to collect rent. Tax office deferrals, it's been pretty easy, as I said, to get a deferral. Those deferrals might need to be converted into payment arrangements. So again, you get a fair bit of sympathy from the tax office at the moment, but that sympathy is not going to last forever. When we had the GFC, one of the things that happened was the tax office, they didn't do any really heavy-handed type of recovery action for quite some time, maybe 18 months. And I think that maybe come the middle of next year, we might see the tax office starting to take a lot more maybe aggressive steps to try and recover some of the debt. And what I mean by that is the ATO is certainly probably one of the largest creditors in terms of company wind-ups in Australia, in that they do a lot of applications to wind up companies. You've probably seen them yourselves, maybe with a few of your clients that may have gone through receiving a winding up application to go to court, and maybe some of them have actually been wound up. So it's just important that if you've got clients that have got deferrals, start trying to get them onto payment arrangements as quickly as possible. Again, those insolvency restrictions, they end on the 31st of December, and the government has brought in some new legislation that's in the process of being put to Parliament. And one of the things that they've introduced is what we call a restructuring, simplified restructuring plan that insolvency practitioners can do with businesses that have debts of less than $1 million. And they, in this particular sort of new legislation that's coming through, a plan's put to creditors, and if they accept the proposal that's been put forward, then there's effectively those debts are frozen. So the one of the series that we have in this series of presentations at the end will be talking about that. They've also got a simplified liquidation regime as well that they're putting in place. And whilst the legislation's been presented, the regulations to it have only just come out today, so it's all very, very new. But because they're introducing that, it would be fair, I think, to believe that the insolvency restrictions that are currently in place won't go beyond the 31st of December, because they've put these other steps in place to try and get as many businesses through as they can. I think what we'll also see, that because these restrictions come to an end at the end of December, what we'll see is that suppliers will start chasing cash. And I think that there's going to be a serious move for a lot of businesses to try and get as much cash in as they possibly can, because whilst they get back on their feet and there's some demand at the moment for their services or their products, that might not continue, and they've also got again debt that has been built up over a period of time that they've got to pay back. And those clients that have say a seasonal business, it's probably more important than ever that they work out that they've got enough cash to see them through the quiet time, because they've probably used some of that cash to get them through the COVID period, but also as working capital to get their businesses back up and running again. So what are some of the practical issues? Well, this is where you guys come in. It's really important that sets of management accounts, budgets and cash flows are put in place, because they're the key. The numbers are actually the key to how a business will do. So if you've got budget and cash flow projections for a client that go out, say, for the next 12 months, a financier is going to have to will want to have a look at that, particularly if the financier's interested in how that particular business is going. What they're going to be looking for is that there is a plan, that, okay, we haven't just sort of come out of it, businesses sort of out of lockdown and is now just trading on. What the financier is going to be looking at is, okay, so again, there might be a bit of demand at the moment, but what happens when that demand drops off? Or does that demand drop off? Does it have enough cash flow to meet those debts that are there? Financial accounts, again, really important. Having everything up to date, I think, is really important to the survival of any business, and for putting together a proper business plan to get through what may be some difficult times next year. Now, there's been talk about an insolvency tsunami that might happen next year. We, as a firm, we don't believe that that's going to happen. What we think will actually happen is that building and insolvency collapses will come in waves, and it may be that you might find some small businesses that just haven't been able to get back off the ground after lockdowns will fall over first. That might lead to another wave of maybe some larger businesses, some medium-sized businesses, and I think that it may very well be the second half of next year before we really start to see the COVID impact start to hit. And part of the reason for that is because businesses still do have some cash flow, and it's when that cash flow runs out that they start having problems. Generally speaking, Christmas is can sometimes be a busy time for insolvency practitioners, because it's the Christmas holiday pay that businesses have got to find, and the cash flow to support that. And they're shut down for some businesses are shut down for from mid-December to mid-January, and it's getting again through that period of time, particularly if that business has suffered during the COVID lockdowns as well. So again, cash flows, budgets, accounts are really important. Put some stress testing on the client to work out what happens if turnover doesn't improve. How long is it going to take to pay some of these debts off? Debtors. Okay, so a lot of clients will have debtors that need to be collected. Again, as I said, I think it's going to be a race to get as much cash in as possible over the next 3 or 4 months. And there's all sorts of things that can be done for a client to try and protect their position. The very first thing is, if they haven't reviewed their terms of trade, they should do that. They should make sure their terms of trade are up to date, that they include the ability to have security via way of the PPSR, because in the event that the company goes into liquidation and they're trying to recover, say, some of their goods from the client that's fallen over, if they've got a PPSR, they're likely to have a much better chance of getting some of their goods back. They'll have no chance at all if they don't have a PPSR and terms of trade that actually support it. So have a look at those contractual arrangements, make sure that that they are up to date. If they, I remember many years ago talking to a group of, it was the Printing Industry Association, and one of the things that I said in a seminar which I was giving to them was, just think, if you've got your sales guy that's come to you and he says, well, look, we need to advance another $50,000 in credit to this organisation, and you generally get the financial controller that turns around and says, well, they still owe us 100 grand and they're up to their limit. And the sales guy says, well, but if we don't support them, they'll fall over. The alternative to that is, if they do fall over and you've given them another 50 grand's worth of credit, and they now owe you 150 grand, how long does that take that business to get that money back? How much profit does it take to get 150 grand back? And sometimes really hard calls sometimes, but again, it's good to go over that debtors ledger and have a really careful dig down into it to see what's actually in there. And if there's a whole heap of stuff that's in 90 days and you've got people that aren't paying, then I think that the call's got to be made at some stage as to how critical that particular client is to the business and what happens if the client falls over. Sometimes the other thing to look at is stock. Stock, there's a lot of organisations we go into and the stock is so old that it's not saleable, or if it is, it's not worth a lot of money. Better off trying to convert that stock into cash where you possibly can. Creditors, simple message here is that transparency and truth and constant communication with creditors, particularly if cash flow is tight, is the key to creditor management. It's the key to financier management. In fact, it's the key to management of most issues that companies have got. By keeping in contact with those creditors, and you'll find there are some creditors that will push for payment more than others, but truth is always the best way. Being transparent is always the best way. And if a client can't pay a particular creditor after they've maybe promised payment, as soon as they know that they can't pay, there should be a call made to that particular creditor and say, look, we just don't, so and so hasn't paid us, we can't pay you. We're trying to collect that money. We'll come back to you as soon as we actually get it and give you an update. That's the best way of actually dealing with creditors, because they appreciate it. And sometimes it just doesn't work. Sometimes the business falls over, and as the liquidator, I know when a company and its directors have dealt well with its creditors, because generally what happens is the creditors will come to us and say, I'm really sorry that this business has actually fallen over. It was a really good business. We dealt with the director. He's always been straight and honest with us. We've got a lot of sympathy for him. And also maybe even where it might go into, say, a voluntary administration, and you want the support of creditors to approve a deed of company arrangement. If you've dealt poorly with creditors want, they want blood at the end of the day. I can tell you, going to a creditors meeting where the director just hasn't done the right thing by the creditors, they're not a pleasant place to be. And generally the creditors will be very outspoken and won't have much support for the business at all. But again, if the director's been upfront and transparent with the creditors, generally will have a great deal of sympathy and support. Expenses go without saying. That's where financial accounts, excuse me, that's where financial accounts come into place. Because by looking at the financial statements, looking at the budgets and cash flows, you should be able to see if there's any fat that might be able to be trimmed off a business. So it's important again to go through those sorts of items to see, where costs can be cut. It may very well be that they might be able to get another supplier. Just going back to suppliers again, I did say before that key customers can lead to insolvency type events where that customer's lost. It also happens with suppliers as well. If there's only one supplier of a particular good, and let's say that supply comes from overseas, and we've had this during COVID as well, we've had this example where stuff's been coming from China and that supply dried up, that particular business had nothing to sell. So again, look at those suppliers. Financing, again, I'll just repeat the comment. Early engagement with the financier is the best way. Financiers are open for business at the moment, and there are some that are certainly lending funds at the moment to good businesses. But again, that's where you as the trusted advisor comes in to help put those proposals to financiers to get working capital for your client. If your client's got financial problems, again, as the trusted advisor, putting together budgets and cash flows and a plan that will convince the financier to continue to provide support are really, really important. So when it all gets too hard for the client, okay, there are some things that can be done. So one of the very first things you could try and do is you could come to an informal arrangement with a particular creditor. So if there's a creditor, might be the landlord, it's negotiating with the landlord to make sure that that business can survive. It's very hard when you've got a whole heap of creditors to try and put an informal arrangement in place. It's not impossible, but generally what you find is that you might get 90% of creditors over the line, and then you get that one or two creditors that say, nah, we're not supporting this, we're going to continue to take action. The one problem that you end up having is once you start doing different deals with different creditors, it tends to get out there. And once you've got one creditor that's getting preferred over another creditor, then you generally find that it all comes tumbling down. So when that happens, if you can't do an informal arrangement, or it's just too hard, it might be the tax office sitting there, might be a whole heap of suppliers, the employers might not have their super paid, they might have the unions on the company's back, landlord might be threatening to evict. You can do a voluntary administration. So with a voluntary administration can end up in 3 different scenarios, but it's up to the creditors to determine the company's future. So the different scenarios are that the administration comes to an end, and I have rarely seen that ever happen in all the years I've been practicing as a liquidator, because the company's got problems and they need to be dealt with then and there. The other 2 options that are available are liquidation or a deed of company arrangement. So with a deed of company arrangement, what that is, it's a proposal that's put to creditors, and it might be that it's flexible. It can be anything that you can pretty much imagine. It could be, for example, that it could be a lump sum payment. The director of the company or the shareholders of the company can procure a lump sum from family and friends to put towards the creditors, and the creditors could accept that. It could be a payment over a period of time. It could be a payment out of trading profits. It can be whatever proposal that a director or shareholder wants to put to creditors, but ultimately it's the creditors that actually determine the company's future. And when I say that, again, if they vote against the deed of company arrangement, then the company will go into liquidation, generally speaking. So if there's no deed of company arrangement put, then it will go into liquidation. And sometimes you use a voluntary administration just as a way of putting a company into liquidation. And I'll give you an example of that. I'm dealing with an IT company at the moment. It's an investment company. It had an R&D tax concessions which were knocked back by the ATO, and the ATO has levied about $400,000 of tax on the company which it can't pay. There's a whole heap of shareholders and investors in this particular company, too many to basically put in a room to resolve, to put the company into liquidation. So a director can put the company into voluntary administration. So in this particular case, that's the way that we've gone, but there won't be a deed of company arrangement proposed. The company ultimately will just go into liquidation. A company can go into liquidation voluntarily, and it's pretty straightforward. What happens is that a directors meeting is called where it's resolved that the company can't pay its debts or may not be able to pay its debts as they become due and payable, and it calls for a meeting of the shareholders. That shareholder meeting, if the shareholders agree to short notice, can basically be done straight after the directors meeting. And then at that particular meeting, the shareholders resolve to put the company into liquidation, and at that point a liquidator is appointed. And we'll talk a little bit more about voluntary administrations and liquidations in the next few sessions. For an individual, there's a couple of things that an individual can do. If they can't reach an informal arrangement with creditors, they could go bankrupt. And there's all sorts of things that happen within a bankruptcy. A bankruptcy is there to protect both the bankrupt from creditors, but also to enable a return back to creditors if there's assets that are available. There can be a Part 10, which is, again, it's a bit like a deed of company arrangement for an individual. There can be a Part 9. So if your debts are less than a certain amount, I think it might be about 130,000. We don't do these sorts of arrangements, but you could do a Part 9 arrangement where it's sort of an amount that's paid over, again, a number of years, might be 3 years or so, and creditors again agree to accept that. And if someone's gone bankrupt, they can get out of their bankruptcy by putting a composition proposal to their creditors, and if creditors agree to it, and generally that's because it's better, the return's better for them in a composition than a bankruptcy, then their bankruptcy is annulled as if it never actually happened. So again, there are things that can be done when an individual's in financial trouble, and again we'll talk about those in a later session. So that's the end of the presentation. There are our details. Look, we welcome any one of you getting in contact with us. We don't charge for any of that. We're just happy to have a good referral network that we can assist. And look, if there's things that ultimately lead to a job for us, that's good. But the network's really important to us, and we welcome the opportunity to try and assist you or your clients with any issues that they might have. So, Chris, did you want to raise? I'll stop sharing my screen now.
Yeah. Back to me. It's really quite interesting. So a lot of echo.
Sorry,
really very interested to hear what your experience with your customers is going like at the moment. Are you seeing distress? Interested in a bit of comment, positive and negative. Really interested to hear from any of you. We just welcome some comment, please. Stacey, I can't hear you yet. Let me see, I'll get you going. Can you speak now, Stacey? Oh, I can't hear you. What a blasted nuisance that is. Stacey, I can't hear you. Would you perhaps send a message to us? Could someone else perhaps try volume, please? Greg, can you try your unmute yourself? Yeah, I can hear you, no problems at all.
Yeah, we actually find a lot of our clients who had around April, they were under a bit of stress, but then in Queensland or Hervey Bay, we had very few cases of COVID, and opened up internally a bit better. And we find we're probably close enough to Brisbane that, especially in the tourist industry, a lot of people have come up from Brisbane to Hervey Bay, and find a lot of our clients have done actually very, very well out of COVID. So at this point in time, we don't have too many that are, or not any really, that are under too much financial stress at this point in time.
That's good.
Yeah.
That's interesting. I think Victoria, but we're both from Victoria. It's been very grim, actually. I can't even imagine what it must be like in the US or parts of Europe. I just can't even begin to imagine it. But Victoria's been bad enough. I suppose the other thing too is, do you have customers that perhaps have got areas that perhaps, companies that need tidying up, for instance, that need closing down? Their sorts of things we're very happy to advise on as well. Miles, you're nodding your head there, I see. Disadvantage of having your camera on, I can see you.
We have companies that we've been working with to improve their position, who have basically owed the ATA lots of money, and they're slowly, once they take your advice, are slowly coming back. And we have others that you seem, no matter what advice you give them, they don't want to listen.
We know the feeling, don't we, Steve?
Yeah, they're the ones that we generally deal with.
Yeah, well, eventually, I think you probably will.
Exactly. They're actually, it's an interesting point, but that generally is what happens. Because once we get appointed to a company, we will, particularly through the courts, for example, and you say you don't quite know what you're going to get, and you'll contact the accountant, and generally what the accountant will say is, oh yeah, look, we tried and we just couldn't get them to get back to us, or they just didn't want to know about it, so we've just moved on.
Yep.
Yeah. We've certainly got one at the moment we're talking about, where two directors, one wants to get out yesterday and the other one, he wants to continue on. Well, he doesn't really. I think he does want to, but he's not willing to face it. So we just can't get them in the same room together. And Northcan, the accountant, I think he last had them in the same room together in January. So really, they're cruising for bruising. They'll end up in a real mess if they can't get together and get a concerted effort. Look, one thing that's come up for me too is last week we had a webinar on financing and refinancing. We had Judo Bank. You may or may not have heard of them. They're a challenger SME bank. They're actually a fascinating bank, really fascinating story. And they were talking about, Steve asked the question, if you've got a customer that's been shut down, how much do you tell them, and the role of the accountant? And that was very, very interesting, I thought. So if anyone would like a copy of that recording, we'd be very happy to send that to you. Just send me a note or via Samantha Campbell, and we can get you a copy of that once. We're just cleaning it up at the moment and tying it up a bit. So yeah, anyway, we're probably going on a bit. Anyone else, any comments, please, or questions? Happy to take comments up. Sorry you can't speak, Stacey, or we can't hear you. If I could lip read, we'd be good. So that's probably it, I think, Steve. What do you think? So thanks very much appreciated.
yes, we appreciate the opportunity of talking to you today, and enjoy the rest of your day. We'll catch you on the next one.
Thanks very much. Bye bye.
Thanks, guys.
Thanks, guys.